Hello, everyone. My name is Krisman. Good morning and good afternoon to all of you. Thank you for joining us today. Before we begin, let's go through some of the housekeeping items. I would like to request you all to mute your audio during the presentation. If you have any questions, please post them in the chat option provided in the Zoom. We will be responding to the questions at the end of the session. Your questions will be answered in the sequential order. And if we are unable to get to any of your questions, then we'll send a response to them separately in an email. We'll also be recording the session and we'll share it with all the attendees. For today's masterclass, which is about how to minimize the impact of rising interest rates in 2022, I would like to invite John Serlick, our speaker for today's masterclass. John, over to you.
All right. Thank you, Chris. Welcome, everyone. Thanks for joining. We've got a good topic today, and it's very relevant to recent developments in business news, rising interest rates. So we'll start with an introduction to tee up the topic. Then we'll get right into the sources of cash flow to repay debt. I mean, we're talking about rising interest rates, rising interest expense. How do you counteract that? Well, pay down the debt. Where do you get the cash to pay down the debt? Well, we'll talk about that and we'll look at 5 different short to medium term sources of cash flow to repay debt. And we'll evaluate each source. There's benefits, there's risks with each of them. Present to you a very nice case study. It shows a nice success. Recap the benefits and the risks. Wrap it up with a conclusion, and then answer any questions. So let's introduce the topic. You're all aware of this. You've been following the news. In the United States, the Federal Reserve Bank said they're going to raise interest rates 3 times. Really in the last week, and with the Fed's meeting yesterday, that concluded yesterday, there's a lot of indications, a lot of speculation that the Fed is going to raise rates more than 3 times. Typically, they raise a quarter point each time. Some experts have speculated that they may rise 5, 6, 7 times this year. Widely expected the first interest rate increase will occur in March, which here we are at the end of January, so it's not that far away. So companies with variable rate debt are going to see those rates go up and their interest expense go up. So what do? Well, clearly pay down your debt. Easier said than done. But we'll explore the sources of operating cash that can be used to pay down debt. Not looking at issuing long-term debt, getting more equity investment, things like that. We're going to focus more on the short and medium-term operational actions that can be taken to raise cash, which can then be used to reduce debt and, of course, interest expense. So what are the sources? As I mentioned before, we're going to focus on short to medium term sources, and those we've defined them 3 to 6 months, 6 to 12 months, and we've identified 5 of them. So let's, without further delay, let's look at them. Let's start off with payables. Increase your payables. Pay your suppliers later, slower. That certainly increases your payables, reduces your disbursements, and increases your available cash. So it's the fastest way to increase cash flow, and it's, to a point, totally within your control. You have control over payables. It's best if you negotiate it with the vendors, let them know it's coming. And we'll talk about that more in a minute, but let's look if you just do it unilaterally. You just say, you know what? We're not talking to anybody. We're not telling anybody. We're just going to pay later. Which in essence, you're violating agreed payment terms. payment terms you've probably agreed to in a contract, or payment terms expressed in an order confirmation, which can be construed as a contract as well. So, you're stepping into unwelcome territory there, and you're going to annoy vendors. And that might be just a nice way of saying it. Initially, they'll be annoyed. As it continues, they'll be more than annoyed. And, that's going to damage your credit rating, because then you're going to be reported to the credit bureaus as a company that pays late. And the more you delay, the more serious your late payments are. And late payers don't have the same credit ratings, credit bureau ratings, that companies that pay on time. So that's going to hurt you. Ultimately, vendors will raise their prices to you to compensate for longer payment cycles. In the short term, it may lead them to revoke your credit limit, and you're paying in advance or upon order, which will totally disrupt your operating cash. Instead of increasing operating cash, it's going to decrease it. So it can backfire on you. And or they'll just reduce the credit limit, which may still result in you ending up paying sooner than you wanted to get your AR balance below the level that they insist on. So there's a risk here. There's a risk of damaging your reputation as a customer, having your credit rating decrease, and possibly having some vendors insist on shorter payment terms or payment with order. And as I said, long-term vendors are going to increase their price to you for two reasons. One, in all likelihood, they're going to have to borrow money to make up for the money that they're not getting from you. And they're going to pay interest, so they need to recoup those costs. Two, it does increase their credit risk, and they'll want to be compensated for that. So while in an emergency, in a desperate situation, you need more cash in 1, 2, 3 weeks, clearly this is a way to get it. It's not without risks, not without penalties, not without costs. So, and again, best if you negotiate it with the vendors, let them know it's coming. You ask them for extended terms, their first reaction is going to be no. Their second answer is probably going to be no as well. But, they need the sales revenue. Hopefully they value the orders and the revenue you give them. So there is room for negotiation there. And they may say, okay, we'll do that. We'll extend your terms for 6 months, but not make it permanent. And it's back and forth, because clearly it's a detriment to them. So payables, a quick and ready source of operating cash, but certainly not without its costs. What's another short-term source of operating cash? Well, on the other side of the fence here, decrease your accounts receivable, collect payments earlier from your customers. So if you look at your balance sheet, you'll be shifting cash from the accounts receivable category to the cash on hand category. Great. And there's really two aspects to this, credit and collection. Let's look at credit first. Essentially, if you sharpen your extension of credit to customers, particularly the ones that pay slow, seriously slow, you may revoke the credit to those that are paying way beyond terms. In all likelihood, they're a poor credit risk. So moving them to a pay with order, pay in advance basis certainly help your cash flow, reduce or eliminate your credit risk, at the risk of losing these customers, losing some sales revenue. Maybe losing sales from financially weak, slow-paying customers is not such a bad thing. And then for the moderately slow-pay customers, maybe you reduce their credit limit. And if you reduce it significantly, what typically happens is you're on a order-by-order basis. They submit an order, you hold the order, somebody contacts the customer and says, I can't release this order until you make a payment. So you go kind of order for order basis. Again, it'll free up cash, reduce bad debt loss, but it's going to increase the amount of work to monitor order by order, contact the customer every time you receive an order, negotiate some sort of payment, that sort of thing. That can be very time consuming. Generally doesn't happen with one call back and forth. And you have to do a lot more monitoring. And ultimately, the risk here is customers could cut your sales volume, particularly if these customers can find other suppliers who don't restrict their credit, willing to extend them credit. They'll move more and more, if not all, of their sales volume to those suppliers. So benefits and risks. The other aspect of reducing AR is improving your collections, improving the effectiveness of your collections. One thing you might want to do is give your collection folks some refresher training, widely available, low cost. The other thing you do is increase the intensity of the collection effort, reduce the follow-up intervals. So instead of following up with some customers once a week, maybe you follow up every 2 or 3 days. Start the collection contact earlier. Instead of waiting till they're 15 days past due, contact them when they're a week past due or 5 days past due. Again, increasing the activity earlier in the cycle. And at the end of the day, more contacts with customers, more collection contacts will result in more cash. But here again, we're talking about this is going to require more work. More collection activity is more work. And here is where automation can really help. Really, we call it a multiplicative increase. More contacts, more cash. Let's double, triple, quadruple the number of collection contacts. And let's move it up earlier in the cycle. And you'll see the results. You'll see the results. But again, you got to be able to cope with that additional work. And, in projects I've been involved with, which were kind of crash programs to release cash from receivables, you can see results in as little as 2 weeks. You'll start to see an uptick in cash receipts in 2 weeks. So when you talk about short-term needs, this is a short-term answer. And remember, all you're doing is you're enforcing agreed payment terms, not looking to change them like you do when you want to extend payables. You're just looking for them, your customers, to live up to what they agreed. All right. What's another source? Sale of assets. Why not? If you've got unneeded assets taking up space, why not sell them, get some cash for them? In theory, it's great. Most companies don't have a large amount of surplus assets. So probably the contribution of this action is going to be modest and can often take longer than you think. I was with a company and ended up trying to sell surplus conveying equipment for the factory floor. And you figure, well, every factory needs conveyor belts and all that stuff. Took a while. And of course, people don't want to pay a lot for used equipment and finding a buyer and that sort of thing. So it can take longer than you might think, but certainly the cash you generate can be very, very useful. Maybe you're selling surplus vehicles. Certainly in today's market, that won't take long. But, for most companies, this is not a huge source of cash. What else can you do? So let's decrease inventory. Sell inventory and don't replenish it dollar for dollar. Start to ramp it down a little bit. So once you sell that inventory, and once that receivable is paid, and you don't replace that inventory, that's a net increase in your cash inflow. Great. What are the issues? What are the challenges? Well, it usually takes a number of months to see this because the inventory items you're going to reduce are typically your slow-moving, low-selling items, products. So you've got the time element here. But again, it frees up cash, and it also reduces the threat of inventory obsolescence, that at some point in the future, you're going to have to scrap these products and dispose of them. So, nice benefit there. But what's the risk? Well, the risks here are actually pretty significant. You risk missing sales if you don't have a product on hand. Customer calls, says, yeah, I want that product. But you say, well, we're out of stock. We'll have it in a week. For a lot of customers, that's not good enough. And if it happens repeatedly, then these customers start saying, well, they're not a reliable supplier. We've run into a number of instances where they've been out of stock. Maybe we ought to look at developing another supplier or shifting our business to another company. And ultimately, that can reduce your reputation as a reliable supplier and shift customers away from that can have huge impacts, huge negative impacts. So it's a source of cash. A lot of benefits from reducing the right inventory. But in our experience, we've learned that it takes a fairly sophisticated analysis to execute an inventory reduction properly. Doesn't mean you shouldn't do it, just means there's risk and has to be executed properly. The last one I kind of chuckled when I included that increased profits. Well, if you can increase profits, why haven't you done it already? What are you waiting for? And here again, it can take a long time to materialize, and there's risks. How do you increase profits? Well, raise your prices. Great. But are those higher prices going to drive some customers to the competition? Risk, revenue risk. Reducing costs. A lot of ways to reduce costs. Secure lower prices from your vendors. But very often, significant cost reduction is achieved by reducing number of employees. That's where the money is for most businesses. And here again, it's risky. The right number of people in the right areas. Sometimes difficult to pinpoint. And in today's labor market, any reductions you make are going to be, if you discover later that, we cut too deep, we need these people back. Well, chances are those people will have already received the job. And if you can get somebody, they're going to be less experienced. So there's a lot of risk there. Risk in raising prices, risk in cutting staff too sharply. So, it's an option. Here again, I would say sophisticated analysis is required to execute the price increases and cost reductions properly. But shouldn't be discounted. Just be aware. So let's look at a case study here, and then we'll kind of recap a little bit more. This was a global medical products company, and they wanted to increase its operating cash. And the chief source that they identified, that they targeted, was from receivables. And they were going to do it through implementing a more effective collections process. And they were going to do that by redesigning the collection process, but also adding automation. Remember, we said collections is a numbers game. The more contacts, the more cash. So how do you increase the number of contacts, the amount of activity, without hiring a lot more people? The answer is automation. They selected Amaja's collection module. The features they liked was, one, visibility to the whole AR asset. Since they are a global company, it helps to have one look with all the different currencies and all. And what really helped them was the automated account prioritization. Collector logs on in the morning and it says, call ABC company first, EFG company second, XYZ company third. And it just does all that for them. And it's prioritized to optimize the results. And the dunning process, for those smaller customers, you probably don't have time to personally contact or write a personal email or call. The dunning process handles that and can be significantly effective. What were the results? Well, actually pretty spectacular. The past due AR as a percent of total AR went from 40 to 15%. They were able to reduce the collection FTEs. Evidently, there was a lot of inefficiency there, by almost half. Took out 7 days of DSO in just a few months. And of course, realized a significant improvement in short-term cash flow. And they went to the receivables well for this. And paid off for them. All right, let's just recap the benefits. And actually, this should be entitled Benefits and Risks. We talked about 5 avenues for improving operating cash, to raise that cash and use it to pay back debt, reduce your interest expense. They all have benefits, and they all have risks. And I'll try to summarize that here. The AR reduction can have a pretty big yield in a short term. The risks are alienating slow pay, high credit risk customers. Asset sales, unfortunately, it's usually a low yield, but very low risk with it. Inventory reduction can be significant generator of cash. Takes longer than you'd like, not necessarily a quick turnaround. And as we explored, there's significant risks there of cutting too much. Increased profit, always risks with raising prices, always risks with cutting costs too much. And increasing your payables can be a source of a lot of cash and can happen pretty quickly. But the risks are ultimately, if you pay your suppliers slower, they're going to raise the price. And, that's going to impact your business as well. So no free lunches here. Nothing happens without some risk and some cost. But this will give you a relative comparison of them. So what's our conclusion? Well, as we looked at the 5 sources of short to medium-term operating cash, our view is that reducing receivables is the best and the quickest way to raise cash to pay back debt. Remember, I mentioned earlier, it involves enforcing agreed contract terms, not violating them, which you do if you just disregard the payment terms you've agreed with your vendors and pay them 60, 90, 120 days from invoice date. there are some revenue risks, but they're with slow pay, high risk customers, and clearly doesn't injure your supplier relationships. But again, to do it right and to maximize the yield is going to be a fairly significant increase in work. You can hire more people, train them, hope they come up to speed sooner rather than later, or you can invest in automation. And, there's it's much more productive than it was a few years ago with artificial intelligence, powered digitization, and this automation can really increase your contacts, your output, and your results. And these are not huge IT implementations. They're relatively modest investment, can be done in months, not years. Questions?
Thank you, John. That's very interesting. We have a couple of questions here, John. The first question is, what are the drawbacks of delaying payments to suppliers to raise cash? This is a question from one of our audience here.
Well, it's violating agreed payment terms, alienating those suppliers. Again, it can work in the short term of weeks, months, but eventually your suppliers are going to extract the cost on you, whether it's with credit rating, higher prices, you'll feel it. So it's not without cost, significant cost.
Okay. The second question, John, is why is inventory reduction a risky action?
It's the risks I outlined earlier. If you do it right, it's great. And frees up cash, frees up space, but it's not easy to do. And the risks are you're out of stock when you get an order. And if that persists, ultimately your customers are going to go to other suppliers.
And I have the final question here, John. One more question we have. Why is reducing past due AR the best way to raise cash to repay debt?
Well, as we said about the AR option here, is its chief attribute is you're just enforcing terms that you already negotiated and agreed with your customers. So you're kind of on the right side of things, as opposed to unilaterally delaying payments to your suppliers. And it's a proven method. I hate to use the word easy, but it's, if you do the right activities and collections in the right quantities, you will see a reduction in AR and an increase in cash. The only variable maybe is how long it takes, but it's a very high certainty way to raise cash in the short term.
Thank you, John. Those are the questions which we have for today. And thank you everyone for joining us for the session. And we welcome you for the next section on 17th February 2022. That's on digital assistance for hire. Thank you, everyone.
Yeah. And this will be a good session on the 17th as well. Maybe open your eyes a little bit on how far AI has come with these digital assistants, and particularly in the order to cash function. Some of those functions, if they're completely manual today, the manual work can be 80 to 90% automated, which is huge, And so that's what we'll explore with digital assistants for hire. Going to be a good session, and hope you can join us. I look forward to it.